Well, good day, traders. It's about time of the week again. We're going to have a look at a review of the G10 FX markets for the week, touching on some of the other asset classes which have very close correlations with these markets and very influential to FX markets. And we can use that as a guide then, or a platform to step into the new week that will be, and have a look at a statistical approach, a quant approach as to what the market's implying for various ranges in these markets, which can really help us with our sort of risk reward and ultimately therefore our position sizing as well. But let's go straight to the board and let's have a look at how things have fared throughout the last 5 days. And you can see it's the Canadian dollar which is the best performer against the US dollar. Now that is a bit of a surprise, I suppose, in some capacity, because we've seen such high volatility coming through in both Brent and WTI and Canadian sands. I think that idea that, as the week's gone on, we've seen a better feel towards the news flow from Saudi. They've talked about the production coming back online. People have come back in and bought those lows from the oil price. The Canadian dollar has been the net beneficiary of that situation. You can also see the British pound up 0.2%. So the pound's fared quite well in G10. The US dollar's been fairly strong throughout the week, but you can see the pound's been up about 17 basis points against the US dollar. Clearly, the news flow is looking quite optimistic there. I mean, I still sit in the camp that there's a higher probability of a general election in the UK, probably in that November window. But for those people hoping for a deal and expecting a deal, certainly the news flow has turned, with the DUP party suggesting they're a bit more flexible around the backstop and looking for a proposal there. Also, Juncker talking about how catastrophic it would be if we saw the UK leaving without a deal, and actually giving some signs that they could be flexible as well. So sterling shorts have sort of closed a little bit, and the pound's been quite good. It has been for some time now. So, something we are watching closely there. But the pound's been quite a good performer. You can also see on the Antipodeans, you can see the Aussie and the Kiwi down 1.2%. I think the RBA has been the really interesting one. We'll touch on that in a moment in terms of what's priced in. But certainly the RBA minutes really opening the door for an October cut. I personally sit in the camp that we will see an October cut. I think the labour market statistics have probably reinforced that. We're going to be seeing from RBA member Lowe, Governor Lowe, on Tuesday at 5 minutes to 8. He's been speaking in Armidale. He could really guide the market there. And I think the idea that also that he also speaks on the 1st of October, the day of the rate decision, reinforces the idea that they'll probably cut on that situation. So, I think a lot of that is probably priced into markets now. But you can see how this has been faring. Now, if you've been short Aussie CAD throughout this week, you've done very well. That's probably been the best performing currency in G10. So that cross is very much in play there. Aussie sterling shorts also very much in play there as well. I think then we can quickly turn, before we look at the event risk for the week, let's actually have a look at the setup and look at what's implied in the market. The first one I want to have a look at is this table here, where you can actually see the central bank meetings which are coming up. And I think if you go straight to what we're seeing at the top of the pile there, you can see that the market now has priced in a rate cut, almost priced in. We've got about an 80% chance of a rate cut coming through in that October meeting. It's probably why you're seeing the Aussie underperformance. But also, I think it's really interesting now that while throughout the week that was, we did see the Fed obviously cutting rates, and that's been a big talking point in itself. I think if you're looking at what's happened with the Fed, there's 2 points to that Fed meeting which really stuck out for me. The first one is the dot plot projection. If you look at that from a very simplistic perspective, the fact is that the median estimate is that we're not going to see any more rate cuts this year. We're not going to see any rate cuts in 2020. We're actually going to see a rate hike in 2021, and the long-term neutral rate is expected to continue being around 2.5%. The other issue there is that the divergence and the disagreement amongst the Fed members is obviously very high. So it's pretty clear that we're getting very much the sort of lower echelons of where the Fed feel comfortable lowering rates. That said, if you do have a look at the implied probability priced into the Fed funds market, you can see there's a 47.5% chance that we get a rate cut coming through in the October meeting, which comes up on the 30th of October. So again, the market is saying that, on balance, that there's a 50-50 chance that we're going to get another rate cut from the Federal Reserve. The other issue is when we go to that October meeting from the Federal Reserve, do consider all the stuff that we've been seeing in the repo market and what's been happening in the funding channels there. The Fed have been coming out in their temporary open market operations and trying to bring repo rates back below 2%. There is a good chance here that the Fed are looking at the level of reserves in the system and saying they're probably getting too low now. They're getting towards that threshold that they feel very uncomfortable of, which is around that sort of 1 trillion mark. And the concern is that will continue. There's going to be a depletion of reserves from the system, and that we're probably likely to see this QE light situation. Now, if you have a look at this chart, which I've been looking at very closely, look at the close proximity that we see between the dollar index and the excess reserves. Now, I've flipped up the excess reserve chart so you can can see here, when excess reserves are going up, the dollar is going down, and vice versa. The dollar's really benefited from this depletion of reserves coming through the currency situation there. So that's something we are watching. That Fed meeting very much in play. Apart from that, I think it's interesting. We saw obviously the recent ECB cutting rates to negative 50 basis points, coming out with QE Infinity. That's another talking point in itself. But the actual swaps rates now are actually pricing a slight hike. I think that's an interesting one. They're clearly not going to be hiking rates, but the market is saying to us that we've reached the lower bounds now. They're probably likely to unlikely to go any lower than this situation. And again, it's really going to be unconventional monetary policy that's really going to set the scene there in Europe. The other one as well, while I'm sort of dwelling on what's been, is what's happening in the Bank of Japan. I want to set the scene for what's likely to happen in the meeting that we get on the 31st of October. Look at the swaps rates pricing 57.5% for a rate cut from the Bank of Japan. Will we see more unconventional policy? Will we see further actions to try and manipulate the yield curve? But the market now is expecting the Bank of Japan to cut, and they're placing an above 50% chance of that. So the central bank meetings as we go into October, the RBA going to cut rates, in my opinion. The Fed, 50-50. The Bank of Japan, probably likely to do it. And all the other central banks are probably unlikely to do too much. So they're the central banks that we're looking at very, very closely. So what do we see when we look ahead? Well, let's have a look at the Fed and look at all the Fed speakers that are coming out throughout this week. You can see that from the Bloomberg chart. I'm specifically looking at John Williams, who speaks at the start of the week. There's a number of other sort of members that we know their stance pretty well, like James Bullard. Going to the later stage of the week, we've got Richard Clarida. For me, he's the most important Fed speaker on the board. Will he actually get a chance to really explore monetary policy? I'm not so sure. And actually, if you look across the data in the US for the week ahead, it's mostly tier 2 stuff, central bank, the conference board, consumer confidence number, durable goods, home sales, all those factors. I'm not sure they're necessarily going to change the dial. We are continuing to watch the repo rates and what that means for liquidity. We're continuing to watch things like inflation swaps, what the inflation expectations saying the Fed should do. At the moment, they're still anchored around sort of 2%. They're not giving the Fed any kind of ammunition. Financial conditions are still pretty easy. We're seeing the S&P looking like it could well break a new high. We're seeing this idea of QE light coming through, where they're going to try and have to influence reserves. QE is not going to be formed on the basis of reflation. It's going to be more about the lack of excess reserves and the banking sector having a sort of scarcity of reserves, and the Fed needs to alter its balance sheet, which could have an impact on the S&P and equities. It should be good for equities, but it also it could be a bit of a headwind for the dollar going forward. We talked about what's happening in Australia. There's not really a lot of data to look forward to. It's going to be very much around what Governor Lowe says. Will he guide the market to a full expectations that we get a cut in that October meeting? We've seen the Aussie dollar looking like it wants to go back into that sort of lower echelons of that 69, 67 range. Will we see further support to that trade and further downside? I suspect there's probably some downside again to the Aussie dollar as we go into that, with the central bank being one of the more easy ones there. There's not a lot to look out for in China as we go into that 1st of October, 70th anniversary of the People's Republic of China. Will we see some upside in Chinese assets as we go into that? I suspect there's a probably good chance we're going to see that. We still haven't seen the reaction from the PBOC to the Fed cut, so there's a good chance that we could get some cuts to either the medium lending facility or their own interest rates, short-term rates in that situation as well. One to watch. We still sit in the camp that there could be some small downside in dollar CNH throughout this week as well, which I think probably could support risk assets more broadly in there. Europe, well, we've got some sort of tier 2 data coming through. There's a lot of ECB speakers, most notably, as you can see from this chart, Mario Draghi speaks twice throughout this week, and once certainly in Frankfurt will be getting quite a lot of attention as well. So watching what happens there. I think the ECB as well, as I say, is something that's very, very interesting, given everything we've been seeing from tiering and probably the lows in those markets there. Now, so if we go to what's expected for the week and the vol charts, I think this is really, really interesting now that we've got cable very much still the highest at the money implied volatility, just above 9%, but that's certainly come down. People are looking, have been sellers of volatility certainly in the sterling crosses. They were very elevated, but they've come down with sort of the better feel that we've been seeing, and of course the idea that they're mandated to go for an extension. If you give an idea that the market's looking for a 149-point move in the week ahead, that goes up to Friday New York cuts. So cable's expected to trade, this is with a 68.2% level of confidence, cable's expected to trade in a range of 126.76 down to 123.78. So I'm kind of using that as a guide for what the market's expecting for this week, given everything that we've got in terms of the news flow and the expected sort of ranges there. You can also see Dollar yen expected trade 108.75 down to 107.29. You can have a look at Aussie dollar 32-point ATR, but you've got the expected move on the week 54 points. So you've got a range in Aussie dollar 68.48 down to 67.40. So you can use this chart just to give you a sense of what the market's predicting. Now I've used the straddle pricing here on the at the money strike. So there's a one standard deviation probability being priced in that moves are going to be contained within these ranges. And I use this as to get a sense of what the market's looking at the data ahead, given the expected moves, and you can really use that to understand how much risk you want to take on your positions. Therefore, you can understand your position sizing a little bit better. I've used the IV rank. That gives me context of where that implied volatility is. So, of course, if that's low, that tells me that people aren't expecting fireworks. And if you have a look at that IV rank channel, you can see some of these implied volatilities are quite low. You're getting into sort of the below 20 percentile. So volatility has been quite suppressed. We're not getting those big moves in FX markets. That really does have a big consideration for your position sizing. You can afford to increase your position sizing and take those stop losses a little bit closer to the market in that situation. I've had a look at the volatilities you can see in things like the VIX, futures, long bond futures and gold as well. They're not particularly elevated despite all the craziness we've been seeing in the short-term money markets as well. So what we're watching, continuing to watch ahead for the week, we're watching any kind of news flow around Brexit. Are we going to see convergence between Boris Johnson and the EU? Well, one thing, certainly sterling traders are seeing signs that could happen. I still sit in the general election camp. We're looking at those three central banks as we prepare for October, that being the Bank of Japan likely to move again, the Federal Reserve potentially moving again. We'll have to see what these Fed members say, and also the RBA very much likely to cut rates in October, and we'll be looking forward to low. So good luck to all people in the markets this week.